One of the most talked about changes of the tax reform is the new qualified business income deduction that is eligible from 2018 to 2025. It is a deduction from taxable income for an individual taxpayer. To help understand this, we'll go over a few key definitions. What is qualified business income? It is defined as ordinary income less your ordinary deductions you earn from a sole proprietorship, S corporation, or partnership. Qualified business income does not include any wages, nor does it include any investment income, such as short-term or long-term capital gains, or interest or dividends. And what is a qualified trade or business? Well, it's unclear to a certain extent, but we interpret it as a trade or business which includes any activity carried on for the production of income from selling goods or performing services. What's a specified trade or business? A specified trade or business is any trade or business involving the performance of services or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. And what is qualifying property? Qualifying property is any tangible property subject to depreciation, which is held by the business at the end of the year and used in the production of qualified business income at any point during the year. The unadjusted property only qualifies for as long as 10 years or the depreciable life, whichever is later. Some taxpayers will be able to take the 20% qualified business income deduction. However, there are some limitations around it, and you have to look at the limitation in two buckets. The first bucket is 20% of your qualified business income, and the other bucket consists of two items which you take the greater of. You take the greater of 50% of your allocable share of W-2 wages paid by the entire company, or 25% of those allocable share of W-2 wages plus 2.5% of unadjusted depreciable property. This limitation on the qualified business income deduction only applies in certain circumstances. This limitation applies for taxpayers with taxable income greater than $315,000. The limitation does not even apply to an individual of specified service businesses with taxable income of $315,000 or less. This 20% qualified business income deduction and the limitations apply to both trusts and estates. Now, we're going to take you through an example to compare C Corp taxation with pass-through taxation. In this example, we're going to use the following parameters. The taxpayer is married and is under the $315,000 income threshold and is a non-service business. The taxpayer's allocable share of taxable business income is $100. Their allocable share of W-2 wages is $20. And their allocable share of unadjusted depreciable income producing property is $15. Now, we're going to compare C Corp taxation with pass-through taxation. As I mentioned, under the parameters, the taxpayer has less than $315,000. Therefore, the limitations do not apply. So we do not need to factor in the 50% of W-2 wages or 25% of W-2 wages plus 2.5% of unadjusted depreciable property. We get to take the flat 20% deduction on business income. When comparing C Corp tax and pass-through tax, there is 21% tax at the C Corp level, which has a 21% flat tax rate. That leaves $79 left for dividends to the shareholders. Assuming the shareholder is paying 23.8% tax on that dividend, the shareholder will incur $19 of tax. That leaves $60 left from an after-tax perspective under the C Corp taxation method. In comparing that to pass-through taxation, we have $100 of qualifying business income. We are eligible for a 20% deduction on that qualifying business income, or $20. That leaves $80 left to be taxed at the individual level. Assuming the shareholder or partner is in the 24% tax bracket, that individual incurs $19 of tax, leaving roughly $81 left from an after-tax cash flow perspective, compared to $60 under the corporate taxation method, providing $21 of benefit under pass-through taxation compared to corporate taxation. As you know, this was just one example and may not be applicable to you. Everyone's situation is different, so we will want to run numbers and pay attention to wages paid and fixed assets on your books. Contact your Anders advisor to discuss and determine how you can best benefit from the tax reform. That's a good question, and the answer is it depends. It depends what your plans are. Do you plan to leave a lot of cash inside the company? If so, C Corp may be the best option. If you're planning on taking most of the cash out of the company a pass-through entity is probably your best choice. That's a good question, and it depends. It depends upon the type of your business, how capital intensive it may be, and the income levels of your partners or shareholders. As you can tell, this tax reform can be very complicated. Please contact your Anders advisor if you need any help.